I have seen countless of my students pay off their debt, including their house, in 5 to 7 years, without getting a raise at their job or changing their lifestyle. They only changed one thing: their knowledge. Debt, how fast you pay it off, and how much you are required to pay towards it every month all goes back to the banking system, which has been carefully crafted by the banks for over a century now. If you learn how to understand and navigate and even manipulate that system, you can pay off your debt in a fraction of the time. Let's start by understanding the banking system. Banks are businesses that are for profit. They are not nonprofit organizations designed to help you. You are their customers and they make money from the way you bank. The interest you pay is how they make a profit. Now, it's important to understand that interest rates are a factor of time as well as a factor of how much you're charged. For example, a $100,000 mortgage at 5% interest will incur a monthly payment of about $860. Now, that sounds fairly normal, but if you take $860 and put it into your calculator and times it by the 360 months that you will pay it on your mortgage, you will find that you will pay a total of $309,600. That is triple what you borrowed. I encourage you to try that same math on your mortgage. The longer you take to pay it back, the more money they make. They don't want you to pay it all off quickly because they'll make less money. So how do they ensure that you will not pay off your debt quickly? What do? They use a process called cash segmentation. Let me explain cash segmentation and how it works. Cash segmentation is where you take all of your money and all of your debt and you divide it all up into separate pockets. Imagine your monthly income as a pie. What they want you to do is to split that pie into as small pieces as possible and have to dish it out to as many places as possible so that you are left with very little pie at the end. No one is fully satisfied, no debt is significantly paid off on a monthly basis, and you're not left with a whole lot extra to do really anything with. That's cash segmentation. You've got a car loan with a car payment. You've got a house loan with a house payment. You've got a credit card with a credit card payment. And the more debts you have, the more payments you have. You've got cash coming in, but they want you to separate it into checking accounts and savings accounts and CDs and money markets and all these different things. You're segmenting your cash in so many different places that you really can't use the power of your entire income. So, how do you reverse this? Well, here's the answer. Get all of your money and all of your debt into the same place. Cash desegmentation, right? Now, what bank products can you use to do this? The answer is a line of credit. See, it's important to understand here, loans are amortized and they're one directional. You can't take money back out of a loan once you put it in without having to go through a refinancing process. But lines use daily simple interest and they're revolving. Think of something like a credit card, which is an example of a line of credit. You can pay any amount of money towards that balance on your credit card, and then you can go use that credit card, swipe and use that same money to buy gas or groceries or whatever the case might be. You're gonna use this to your advantage to keep all of your debts and all of your cash in as few places as possible. A HELOC is another example of a fantastic line of credit that you can use to execute this strategy. Now, we desegment our debt by consolidating all of the debt into one place and then storing all of your cash there as well, using the line of credit to pay your monthly bills. So here's an example of a family using the traditional method that we have all been taught for our finances. Let's say this family makes about $5,000 a month. They have a mortgage payment on a $200,000 mortgage that they pay about $1,200 a month. They have a $50,000 car loan that they pay $600 a month for, and they have a $15,000 balance on a credit card that they pay another $600 a month for. They use $1,200 a month for non-debt related living expenses, we'll call this lifestyle, and they use $1,400 a month for savings such as 401k, taxes, social security contributions, etc. But here's the thing, if you add all those things up, their cash flow is zero. They spend all of the money they make every month, and it's a result of that cash segmentation where their money is going everywhere. They're slicing up the pie into very small pieces and they're sending it all over the place. Now, let's get into how we can resolve this. It's a strategy that I call speed banking. Let's use that same example that we used before, that same family, but this time they're gonna do it in a desegmented way. Let's say their house is worth $300,000, they owe $200,000 on their mortgage. They go into the bank and they refinance their mortgage into a HELOC, a first position HELOC, moving the balance of the mortgage over into that new line of credit. They pay off their $50,000 car with the HELOC, and they pay off their $15,000 credit card with the HELOC, consolidating all of their debt into one place. They stop segmenting for savings, meaning they stop putting money into their 401k contribution. We've got real estate investing strategies in different videos that we will share for your retirement accounts, right? But for the sake of this video, they stop contributing to any kind of savings account. They just dump their entire income into that HELOC. Now, with all of that debt moved into the HELOC interest payment is $1,800 a month. Now they have $3,200 a month in cash flow without getting a raise of their job or changing their lifestyle. They just increase their knowledge. They leave their cash inside the HELOC and they use it like their new checking account. Every time a paycheck hits that account, it looks like a payment to the bank. So the payment is being taken care of, their debt service goes down, their cash flow goes up. Let's take a look at the math and how this works out. So they have a $265,000 balance now in their HELOC. They have $3,200 a month in cash flow because they desegmented and got rid of all those payments. So if we take $265,000 worth of their debt balance and divide that by the $3,200 a month in cash flow, they will pay that off in 82.8 months. That's 6.9 years, all without getting a raise of their job or changing their lifestyle. This is incredible stuff, and you can start using this strategy right away. You don't have to be rich to do this. Now, keep in mind that there are risks in every financial strategy, so be sure to educate yourself thoroughly before you go out and start playing with these strategies. Now, the best way that I know how to do that is what I'm gonna share with you next. And I get that we've only scratched the surface on this strategy in this video, and I would like to go into great detail with you and explain my exact formula for paying off debt in a fraction of the time. So to help you get started, we're offering a free strategy call with me, Maylee, or a member of our elite coaching staff. All you need to do is go to www.flippin.education or click the link in the description below to get your free strategy call today. I want to dive deeper into this topic with you, and I have a full fleshed out strategy that I want and need to share with you, but it's just too much for me to share on YouTube. But this is why we've opened up our time and our coaching staff for a free needs analysis call specifically for you, so that you can learn this entire thing and so that you can start making money with it and start paying off your debt as quickly as possible. Just go to www.flippin.education and take advantage of this, because we're gonna have to take it down soon. We only have a limited number of spots that we've set aside. So please go take advantage of this now. Book your call today. That's www.flippin.education. Get there today. I just wanna make sure that you have all of the tools and all of the resources and knowledge that you need to go out there and be successful. And until next time, we'll see you on the flip side.